It was a sleepy day on Wall Street with the S&P 500 closing down by 0.10%. We didn't really see much more activity on the other indices either. But the good news is we didn't have a major breakdown, and previous trends are mostly holding at this point. So we'll review all of that, see what it means for our postures, and then we'll get into our trade application example where I wanted to kind of flip things around a little bit and look at a bearish trade on an energy stock. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's April 6th, 2021. First of all, if you're new, welcome aboard. Remember to go on to YouTube, click subscribe on our channel, then go down to our description area and sign up for our email distribution list where we'll let you know which stocks in the S&P 500 are giving you overbought and oversold cluster signals, in addition to notifying you when these videos are posted. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZ. I would encourage you to follow me there. If you're interested in following the Market Scholars handle, it's just @MarketScholars. And last but not least, we do have a presence on Facebook. Feel free to join us at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's activity. And as you can see, I've got chart 4B pulled up here in front of us. And as mentioned in the intro there, not a whole lot to discuss today. Just a sleepy day in the neighborhood, which is kind of odd, I might add. Many of you know that David just took off on his vacation here. And the inside joke around here is whenever David goes on vacation, the markets start falling apart in a big way. So far, so good. One day into this, we haven't really seen that, but be on the lookout for that in the coming week. Anyway, as you can see here, despite slight pullbacks of 0.1% on the S&P 500, 0.29% on the Dow Jones, 0.05% on the NASDAQ Composite, and 0.25% on the Russell 2000, all of our postures remain bullish. So there wasn't enough of a give back today that would lead you to believe that the intermediate term posture is changing. It's possible that in the short term, we might have a little bit of a give back. You can see here earlier in the session, we did hit another all-time high in the S&P 500, even though we closed just shortly below that level there. But we're pretty well extended off of that 30-day moving average at this point. So it wouldn't be entirely surprising to see, 3 or 4 days of give back there, and then hopefully find a bit of support around that moving average again like it did the last time around. That would not wreck that trend. It would not make that uptrend in jeopardy, even if we had that type of behavior. So we'll see if that happens or not, but right now what we do know is that markets have been bullish. We did touch an intraday all-time high, and at this moment in time our postures do remain strongly bullish across the board. Not only that, but I'd also add that there were a couple of interesting additional elements to the charts on the bottom here. Notice the NASDAQ Composite and the Russell 2000 both have a green moving average now, whereas the previous day they had a yellow moving average. And what that signifies is price is now above a rising 30-day moving average. Previously, price was above the moving average, but the moving average was falling. So we've had enough upward action here more recently where the moving average is starting to curl higher on both of those as well. And of course, that's not in question with the charts up above. The S&P 500 and the Dow Jones already had their green lines well in effect. But on the other two, there's been a little bit more chop and slop. And so it is a good sign to see the bulls kind of win the day here and see those moving averages change the colors that they are. I would also point out that we do have what's known as bullish intermediate confirmation signals that do exist on the bottom two charts. Now, I will point out that neither one of them are considered, of the strongest variety or of the most interest, and a couple of reasons for that. First of all, let's explain what a bullish intermediate confirmation signal is for those of you that might be newer. What we're looking for is the green line on the market forecast, what we refer to as the intermediate line, in a bullish position. And in order for it to be bullish, it has to do one of two things. It either has to be rising between 20 and 80, or it just simply has to be in the upper reversal zone. Well, with both the NASDAQ Composite And the Russell 2000, that green intermediate line, is rising between 20 and 80. So we now know that we have bullish postures, not only bullish, but strongly bullish, because they're both above the 50th percentile. Now, in addition to that, we are also looking for the red momentum line, and we'd want to see that in the lower reversal zone. The lower reversal zone on the market forecast technical indicator that you find on the Thinkorswim platform and other TD Ameritrade resources, that lower reversal zone is 20. And so you can see in the labels here, even if you're watching this on a phone or something, that the momentum line on Russell 2000 is at 6 right now, so obviously below 20. And then also on the NASDAQ Composite, it's at 17 right now, again below 20. So in both of those cases, they both qualify for that bullish intermediate confirmation signal, which is typically known as a buy the dips signal. However, this one is not overly ideal because there wasn't much of a dip to be buying. This was a rather quiet give back type of a day where even the Russell 2000, which was down worse than the S&P 500, still only down 0.25%. So that's not much of a dip to buy there. And that is kind of manifesting itself in where the position of the blue line is. While the blue line technically is not part of the bullish intermediate confirmation signal, it can help us understand whether we have more legitimate setups or not. Ideally, we want a healthy exhale in the form of that blue line kind of finding itself between 20 and 50. And notice right now that blue near-term line on the Russell 2000 is at 70, and over here on the NASDAQ Composite, it's actually in the upper reversal zone at 88. So in other words, yes, technically there is a bullish intermediate confirmation signal, but neither one of them would be considered an aggressive dip. And so some of the rest of you might feel like, you know what, you might want to wait for a further pullback before getting too excited about that particular setup. All right, let's go ahead and take a look at another chart now. Let's take a look at our 3 green arrows chart, and that will be chart 4D. So as we're looking at this chart, a reminder that the background colors here will tell us whether we have 3 green arrows, 3 red arrows, or a mix of green and red arrows. And as you can see, on all 4 of our charts, we actually have a green background color right now, telling us that we do have 3 green arrow signals on all 4 of these index charts here. And just a reminder for those of you that might be newer to what 3 green arrows is, that's language that many of you are familiar with, but not all of you perhaps. And so it is just kind of colorful language to discuss 3 different technical indicators and trying to determine whether they're all bullish at the same time or all bearish at the same time. Obviously, that doesn't guarantee anything about the future, but what it does is it helps us understand whether we are in a better trend trading environment or a worse trend trading environment. And when we have 3 green arrow setups, traditionally that represents a more fertile time period to be a trend trader. For those of you that have an interest in trend trading, feel free to join my Monday top-down trend trading class that I teach at 11 a.m. Eastern Time if you're a plus or a premium member of our company. And there we do practice that mindset of looking for stocks that are exhibiting relative strength within sectors that are exhibiting relative strength, within industries that are exhibiting relative strength. And so yesterday we concentrated on a financial stock, which is the one that we ended up buying for our class portfolio. So if you're interested in that, feel free to check out that recording. It is available to you right now. But as we look at these 4 charts in front of us, I would say that the top 2 look more impressive to me in terms of their trend trading capabilities. The S&P 500 and the Dow Jones still have a nice upward ascent to their charts, with the S&P 500 hitting an all-time high earlier today, and the Dow Jones Industrial Average hitting an all-time high just yesterday. Notice that with the NASDAQ down below, we haven't hit an all-time high since back here on February 16th, and for the Russell 2000, we haven't hit an all-time high since March 15th. So those 2 are lagging in this environment where the market has been focusing a bit more on value stocks, and we'll have that conversation tomorrow morning in my factor-based swing trading class, but it's something we've shared with you here many times over the weeks as well, that this market has kind of transitioned towards more of those reopening plays and value stocks that had kind of been left behind last year. And so those are the types of companies that you'll find in kind of the big blue chip indices out there, like your Dow Jones Industrials and your S&P 500s. This is a market that isn't quite as excited about high-tech growth stocks the way that it once was back in 2020. So anyway, good sign here that all four of our charts do have a 3 green arrows signal. Let's go ahead and take a look at a longer term view now. And for this, we'll use chart 4C. This will be our 1040 crossover method chart. A reminder that when we're looking at this particular chart, these 4 U.S. equity indices are plotted out over 3 years in time, so that way it gives us kind of a broader view of what's been happening with the stock market as opposed to the 3-month views that we were just looking at a moment ago. Also be aware that these candles that you see in front of us are 1-week candles, and gives us a sense of whether we're trading in the upper halves of the ranges or not by kind of looking at where their closing price is in relationship to their highs or their lows on every one of those candles. And so right up here as an example on the S&P 500, we are trading near the top of that candle. Now it is early in the week, so we have to remind ourselves of that. This is only Tuesday, so things can change very quickly with a weekly candle in the next 3 days. But right now, so far so good. We've had a good push to the upside. But what we're really looking for in these particular charts are crossovers of the moving averages themselves. When you're looking at these charts, we are looking at an orange line versus a blue line. The orange line is the 10-week moving average. The blue line is the 40-week moving average. And we're looking for key points on the chart where those moving averages are crossing one another. Now, this is not something that is a highly sensitive trade setup. This is something that happens maybe once or twice a year if you're lucky, sometimes even less than that. So anyway, this is something that perhaps some of you will use to kind of gauge whether these are bullish conditions for maybe your 401k money. Obviously, we can't give you any advice or recommendations, but some of you might have 401k mutual funds where you can only make a handful of transactions per year, and you just want to try to catch the majority of any major trend that might be establishing itself. And so I would say that this chart has done a reasonably good job of getting people back into the markets reasonably quickly. Obviously, last year was a pretty abnormal year where we had that really bad rug pull that took place within the market as a result of the coronavirus situation, but we very quickly got back on track with upward trends after that. And so most of these would have gotten you back into the market relatively early. The earliest of them would have been the NASDAQ Composite, which would have gotten you back into the market in early May last year after just taking a few weeks off there during that time period when things got a little chaotic. Some of the others took a little bit longer to get you back in because they didn't move quite as quickly off the bottom. But nonetheless, for the most part, these trends are still holding here. One thing I've been pointing out to you guys that I'll mention here again is that you do see that this PPO line that you see below the charts is starting to roll over on both the NASDAQ Composite and the Russell 2000. What that is signifying is that these moving averages are starting to pinch together. And when they do that, it's giving you the sensation that the shorter term or more recent momentum, I should say, is starting to fizzle a little bit, and that is being measured by that 10-week moving average versus the 40-week moving average. And so if we've seen more chop and slop recently, it's going to show up first on the orange line because that's more sensitive. It's only tracking 10 periods of information versus the blue line, which is less sensitive, tracking 40 periods. So you don't really like to see when those lines are pinching together, and that is what the PPO is showing us on those two bottom charts. The two charts on the top still look good. You can see here that they're either flat or going higher, and that is telling us that the distance between the moving averages is either being maintained or expanding away from one another, which is generally perceived more bullishly, like there's actually some good acceleration of that momentum that might be taking place there with the Dow Jones Industrial Average. All right, let me go ahead and pop on over here to the internet briefly. I always like to get an opportunity to say thank you to those of you that help support this project on YouTube. Obviously, it is a free video, and we want to get the word out about our company, and we know that there's no better way to do that than through you guys collectively. So thank you to all 124 of you that clicked a like for me the last time around there on Twitter. Anytime we're up and over 100 likes, I feel like it's worthwhile to do the videos. So if you guys want to see the videos continued, obviously do your best to help support us. Now, on that point, remember, because David is out of town this week, there will not be a video tomorrow, which is Wednesday, and there will not be a video on Friday. Those are the 2 days that he would normally be doing those videos. So I'm doing it here today on Tuesday, and I will plan on doing it again on Thursday, but just want to make sure you guys are aware that David is not only out of town, he's out of state, and he's across an ocean right now. So we're hoping he's enjoying himself with some rest and relaxation. He certainly deserves it. Also, while we're over here, quick reminder of what our schedule looks like for our Plus and our Premium members. I mentioned before that I taught my top-down trend trading class yesterday, where we concentrated on purchasing a financials company that was really trending nicely. We also got an opportunity to look at selling a put on a consumer staples company yesterday afternoon in my options for long-term investors class. And then earlier today in the dividend growth investing class, we focused on a head-to-head matchup within the consumer discretionary space. So if you're interested in any of those topics, those recordings are available for our Plus and our Premium members to watch. And then tomorrow morning, as I mentioned before, will be my factor-based swing trading class. We'll get started with that right around 11 a.m. Eastern time. So that way we can see if value is still leading in this current marketplace. And then tomorrow I'll be doing my question and answer session. So again, a little bit of a lighter week here on our calendar as a result of David being out of town, but we'll get back into a more full swing of our class schedule again pretty quickly here in the coming weeks. All right, let me get back on over here to our charts, and let's do some 12 grid analysis. So I'm going to go over here to kick things off with chart 5A, which will be our asset class 12 grid. And as we pull this up here, you can see that we do have one pink chart on the board, which makes it a little bit different than on Thursday when I did the video last. Remember that day, we actually had a clean sweep for green charts on this first 12 grid, and I was mentioning to you at the time how incredibly rare that is. It's not rare to find the sectors all green, but it is rare on this first one with the asset classes to have them all green or all red. So today we kind of go back to a norm where we have a bit of a mix of green and red. In this case, it is oil that has kind of started to lag a little bit here. Now, oil was up today, so I want to make sure we're all aware of that. The dollar has actually fallen for 4 straight days. Been talking about this as well. Remember last week in both of the presentations I did for you, we talked about this idea of somebody who had bought the dollar back here on this oversold cluster signal. So let me right click and go to the maximize sell so we can see this. We had this oversold cluster signal here on UUP almost exactly 3 months ago when all 3 of those colored lines were in the low reversal zone, telling us that that might be an interesting reversion to the mean type of a trade to buy. And then had you held UUP all the way until you got this red dot up here, which is an overbought cluster signal where the green, the blue, and the red lines are all in the upper reversal zone at the same time, you would have had a pretty nice play there. Now you can see that ever since getting that overbought cluster signal, we have had 4 straight days of give back. However, we still are in an uptrend on this chart, and it kind of goes to show you how extremely bullish the posture was leading into the overbought cluster signal, because usually if you have 4 healthy days of give back like we've seen right here, the background color of the chart will kind of start adjusting towards that light pink color, which tells us that we have a weekly bearish posture. But in this case, we were so extended above that moving average that even 4 straight sell-off days was only enough to push that green line lower, but yet not quite to the point of crossing down and through the upper reversal zone there. In other words, from 80 down to 79. We are still sitting at 86 on UUP. So in other words, this could be an interesting situation for those of you that have been waiting for an entry point into the US dollar. Right now, we're still in that decline right here, and we don't know when that ends. But if you do start seeing stabilization, somewhere between here and the rising 30-day moving average, that could be an interesting play back up to the upside. So the dollar was down today. Typically, when the dollar is down, that can help support commodities prices. So if we take a look at gold, you can see gold was up. So that makes sense. Dollar was down, all else being equal, gold was up as a commodity. And like I mentioned to you guys on Thursday when I did the video, gold's becoming a little bit more encouraging. For the longest time, it was kind of in the penalty box here for us because it kept on sagging with lower lows and lower highs. Now, all of a sudden, we're starting to see some more positive developments here. And we can actually add one more line item to our notepad in terms of bullish things that we're on the lookout for here, when today we cut up and through that moving average. This is the 30-day moving average here. Remember, we already had the bullish posture on this as late as, or as recently as last week. On Thursday, that was the case. But I said, we've got to be somewhat cautious here because we've seen those things be head fakes in the past. And we're going to want to start waiting to see if it can start getting up and through this prior resistance. And I was pointing out this candle here on March 17th. If we can spend about 3 days or so above that candle right there, that'll be a pretty strong sign that this chart actually does want to change its trend. We see a double bottom here from the candle on March 8th and the candle on March 30th. So that's a strong sign. We did not breach that prior low right there. Not only that, but if we can get up and over this candle here, we could legitimately make the claim that we now have a slightly higher high in the near term. And while doing that, if we can establish kind of a home zone here above that moving average, that's even better, because in the past, as we had approached that falling moving average, it was oftentimes used as resistance. And as recently as yesterday, you could have still had that philosophy. Notice that yesterday, gold went up and touched the moving average and then bounced a little bit lower, so it closed off of the highs of the session, almost as if it was, meeting up with some sellers right at that moving average. And you can't blame them. Back here we had something similar, and back here we had something similar where that moving average was acting as resistance. So today was a really good sign there for gold, where we are able to kind of leapfrog over that downtrending 30-day moving average. Now we still have to contend with this horizontal resistance over here, but this was a very positive sign here for gold. Now, going back to what I mentioned a moment ago on the dollar, with the dollar being down 4 straight days, gold was effectively up 3 out of those 4 days there. And so if we do see a renewed uptrend for the dollar, it is possible that gold might fall back down below that moving average. So, we look at this information on a day-by-day basis, try to make that determination. But those are things that you guys can watch out for on your own as well. And then I kind of mentioned this before, but just to put a ribbon on it, here's the chart of USO, which is an ETF that we use. It's kind of a proxy for oil. And you can see here that oil was up today. However, it closed well off the session. So like gold, it was up, partly perhaps due to the falling dollar. But in this case, you can see that USO was trading much higher than where it closed. We had kind of one of those rare black candles in that particular case there. There's only a handful of those on the chart there. So in this case, you can see that it's kind of establishing its home zone directly below its 30-day moving average. Unlike GLD, that's a little bit more concerning in this case. And that's, partly why we see that this was the chart that I had mentioned before, is in kind of that pink color of the background, telling us that this is actually a bearish posture. Not only that, but it could actually be considered a strongly bearish posture if you are to use the traditional rules of the intermediate green line. That green line you'll notice on the market forecast technical indicator is falling here, and it's below 50. So that's telling us that's strongly bearish in this case. So while we had an unbelievable run to the upside for oil over the last few months, the last 1 month has been spending more time below the moving average than above it. So that becomes much more concerning. And as mentioned in the intro, that kind of plays into my trade application example I'll show you here in just a bit, where we are going to take a bearish trade on an oil and gas stock. So this is oil prices themselves, but there are obviously a lot of ways where you can do bearish trades on the stocks that try to extract the oil and gas out of the ground. Anyway, as we take a look at the rest of the charts, they are largely green. In terms of major market moves, we didn't really see much of anything today. Even Bitcoin was pretty quiet here today. I guess you could say that foreign stocks had a pretty big move in terms of the developed foreign stocks. They were down over 1% today. So while EEM was positive today, and similar to what I had mentioned about gold, it was good to see EEM get up and over their falling moving average. That's the first time we can make that claim since going all the way back here to the end of February. So that was a positive move for EEM, being up 0.5% today on the same day when its cousins in the developed foreign stock world actually had a significant down day, down 1% here today. So that's interesting behavior that we're seeing there. I know a lot of people have been watching this story with Credit Suisse and some of the developed banks in developed countries out there, and their exposure to the Archegos Capital situation, that big family office that blew up and kind of left a lot of the banks holding the bag. And so perhaps that was playing into that performance here today. Let's go ahead and take a look at our sector 12 grid now. This will be chart 5C for those of you following along at home. Now, as we're looking at this, you can see energy is the only one that has the pink background. And so it kind of shares that commonality with our last 12 grid, which was looking at asset classes, saying that the price of oil itself now had a bearish intermediate posture according to the market forecast. We can now make the claim that the energy sector is also the only one that has that bearish posture on the intermediate version there. And you can see that it is still leading. So this is what makes it a little bit confusing. We're in this time where we don't really know what to make of it, because on a 3-month basis, energy actually still is the leading chart on this board. Notice that we have these little widgets on the right-hand side that will tell us how much a security is up or down over the life of this trade, which all of these are the life of this chart, I should say. And all these charts are 3 months in length. So basically what this is saying here is that energy is up basically 20% in the last 3 months, 19.84% to be exact. And if you look at the little widgets to the right of all the rest of the charts out there, you can see that energy is actually the one that is up the most in the last 3 months. So sometimes that can be confusing when you're looking at the posture as we are right now. And the posture says, that we're bearish from an intermediate perspective, yet the performance tells us that this is the best one on the board. And the reason for that is the recent breakdown. The intermediate posture is a little bit more sensitive than just looking back at a simple, 3-month version of performance. And you can see here where that makes sense. We are starting to trade near the lower halves of the price candles in the various ranges in the recent term. In fact, you could also make the claim that energy stocks are the only ones that are trading below their 30-day moving average right now. So it is a pretty peculiar situation, and it just goes to show you how aggressive that move was in oil and gas stocks in the last 3 months, where when they've given back as much as they have here recently and are trading below their moving averages, they still have the best performance over that time period. So it's been wilder trading for oil and gas companies without a doubt here recently. And the rest of the charts are firming up pretty nicely. Don't fall asleep on real estate. That real estate chart in the lower right-hand corner looks pretty impressive there from a trending perspective. We still have strong trends in place with the materials, industrials, communications and financials as well. So we've got some pretty strong charts out there. Energy's kind of the exception to that rule, where it's struggling to stay above that moving average at this particular moment in time. So that leads us now into our trade application example. It's a good segue because, as I mentioned before, we will be focusing on a bearish energy trade with this example. So for this, I'm just going to come on over here to chart 4A, which is one of our normal market forecast one grid charts, and I'm going to type in ticker symbol MPC. This is Marathon Petroleum, and so be aware this is not the MRO, which is the Marathon Exploration and Production Company. This is the refining company here that I'm dealing with in this case. This is MPC. And you can see here that MPC has recently gone from a bullish posture to a bearish posture. On this 3-month chart that we see in front of us, we can see that for most of the last 3 months, it had this green background color telling us that the green moving average, the green market forecast line was positioned bullishly. Things changed in a pretty big way here on March 18th when we crashed through that moving average. Ever since that date, we've been spending most of our time below that moving average. And with the exception of 1 or 2 days along the way, we've had a bearish posture there ever since that big give back day on March 18th. So today, I decided to do a bearish trade on this security. As I always do, we put the trade details in our Telegram app for those of you that are premium members. But the trade that I did was what's known as a bear call spread, where I sold, I think it was the 57 call, and I bought the 58 call. And when you do that, you create a credit. And what you are hoping to accomplish by doing a trade like that is basically placing a bet that this company will not go and close above your short strike on expiration date. So in other words, we've got a stock that's trading here around 53 bucks right now that we don't want to close above 57 on expiration date. That brings up another point, which is I intentionally chose a weekly options contract in this case. I think it was the last weekly contract in the month of April. The reason I did that is because, like a lot of companies, this company will be reporting their earnings here in the coming months, as we're just about ready to kick off a new earnings season here. And so by selecting the weekly contracts that expire the final week of April, this trade will be done prior to this company announcing their earnings for the quarter. And that helps me along with a trade like this, just in case the company had a really good earnings report and a perfectly good bearish trade would basically fall apart with the snap of a fingers if the company were to report a really strong quarter and gap higher. I don't know if that's going to happen, but at least we don't have to worry about it in this particular case. And I was able to get just over a 30% return on risk by doing that. And so again, for those of you that are premium members of Market Scholars, check your Telegram app. You'll see the exact trade details in there with the fill prices and the screenshots and all that jazz, as is always the case when I do my videos here. So that's what I had for you here today. Oh, one other thing I wanted to mention about this chart, it did have a little bit of a bearish near-term divergence as well. Notice that we have this blue line right here that peaks on March 26th, and then it peaks again here on April 1st. That's a lower high on the blue line. The two candles, price candles associated with those two dates are this candle right here that I'm circling and this candle right here that I'm circling. So price went slightly up at a time when the indicator went slightly down, and so that's giving us a heads up that we might have some pressure, some selling pressure under the surface that not everybody is paying attention to right now. So not only do we have the bearish intermediate posture right now, but we could also make the claim that we have a bearish near-term divergence signal with that blue line at this moment in time. Okay, so that's what I had for you. If you got value out of listening to the presentation tonight, I just ask one simple thing out of you. Take 5 seconds out of your day to click like for me there on Twitter. You can do that either directly on Twitter, where I'll have it pinned to the top of my timeline, or you can do it while you're watching the video directly below the video on our website at marketscholars.com. StockTwits.com. For those of you that are watching it directly on YouTube, you can check the Twitter link within the description to like it there. And then you can also get the Twitter link for those of you that are on our email distribution list. It'll be included in the email itself. So 4 different ways for you to accomplish that, however you best feel comfortable with that. But I want to thank you for paying attention here during the presentation, for hearing me out, seeing what we can discover with the markets. It was a quiet day, but we are seeing maybe some wear and tear on those oil and gas charts that we want to pay attention to. We also want to make sure that we're paying attention to perhaps a little bit more robust bullish activity out of gold. And so a lot of that might be dictated by the dollar going forward, and I'll look forward to sharing my analysis with you once again on Thursday. So until then, I want to wish you all the best of success with your trades and your investments. Goodbye for now.